Chapter 14, Cost Planning. So Chapter 14, Cost Planning, is going to deal with a variety of things that we have to take into consideration when we're looking at costs all the way up through and into looking at the budget. So we start with some terminology with the budgeting process, explaining why the budgets are useful and what management philosophy can influence the budget process, looking at different budget timeframes, the impact of the sales or revenue forecasts on the overall operating budget, preparation of the purchases or production budgets. We're going to illustrate how those cost behavior patterns that you've learned about are used in developing our operating expenses budget, explaining why and how the budgeted income statement and the balance sheet are prepared, preparing a cash budget, and explaining why standards are useful in the planning and control process. We'll determine how the standard cost of a product is developed and describe how those standard costs are used in a cost accounting system. The decision-making process begins with strategic, operational, and financial planning. Implementing these plans and executing operational activities provide the performance data. After the data is collected, performance is then analyzed and the feedback is generated to refine the process. A budget is a comprehensive financial plan for achieving the financial and operational goals of an organization. Planning involves developing objectives for acquisition and the use of resources. Control involves the steps taken by management to ensure that those objectives are attained. The benefits of budgeting are enhanced managerial responsibility, coordination of activities, performance evaluations, and the assignment of decision-making responsibilities. A participative budget allows the flow of budget data from the supervisor level to middle management to top management. It can be very time-consuming, but it really enhances employee motivation and the acceptance of goals. So you can think of it as a bottom-up budget rather than a top-down budget. The annual budget may be divided into quarterly or monthly budgets. As illustrated, a continuous or perpetual budget is usually 4-quarter budgets that roll forward 1 quarter as the current quarter is completed. So you are always in a budgetary determination cycle. The nice thing about a continuous or perpetual budget, whether it's in a quarterly or a monthly illustration, is that you are aware of factors that impacted this quarter that may impact the same quarter a year from now. You are more in touch and more intimate with the relationship and actions of operations and can make better decisions on how that is going to impact your future. The budget prepared in the last quarter of 2015 contains the next 4 quarters of operation in 2016. The budgets as of the 2016 first quarter contain the last 3 quarters of 2016 and then the first quarter of 2017. This process just continues, moving forward one more period, whether it's quarterly or monthly, depending on how your budgets are prepared. The budgeting process really begins with what's called the sales budget or the forecast. The sales budget is developed using an estimate of the quantity of goods or services to be sold multiplied by the expected selling price per unit. The purchases budget for a merchandising company or the production budget for the manufacturing company is then developed based on that sales forecast. For a merchandiser, the purchases budget and the operating expense budget are used to prepare the budgeted income statement, budgeted statement of cash flows, and budgeted balance sheet. The manufacturer must prepare direct materials, direct labor, and manufacturing overhead budgets from the production budget to create the cost of goods sold budget. Then the cost of goods sold budget is used to prepare the budgeted income statement, budgeted statement of cash flows, and the budgeted balance sheet. As you're moving through to creating the master budget, we have to create all of these different pieces. And as you can tell, some of these are based off cost behaviors, such as direct materials, direct labor, and manufacturing overhead. As you can see, the sales budget or the forecast is really the most important element because it starts the entire process. Let's look at the sales budget. This is heavily reliant on estimated units of sales and an estimated unit price, which are developed from an analysis of economic and market conditions and the forecast of customers' needs provided by the marketing personnel. This is not done in isolation or a bubble. We do not just choose an amount of units and a unit price. There are a lot of factors that come into this, and several departments will be involved in ascertaining what a realistic sales budget will look like for the coming period. Let's use Jones Company, who are preparing their budgets for the quarter ending March 31st for its one product. Now remember, most of the times there's a lot of products that are at play, and a sales budget or sales forecast is very complicated when you're looking at a product mix. But utilizing only one product that sells for $25 per unit, their budgeted sales for the next 4 months, based off economic and market conditions and acceptable price points, including competition and other factors, is $25 per unit. In January, they plan to sell 10,000, in February, 12,000, in March, 15,000, and in April, 11,000. So we carry that through at $25 per unit, and we arrive at these amounts: 250,000, 300,000, 375,000, and 275,000. We need the April calculation in order for us to calculate March ending inventory computations, because we're going to have a actual goal of what we want our ending inventories to be in order to facilitate the coming period. Once we know what the sales are, we then have to look at production. Production must be adequate to meet the budgeted sales and to provide a sufficient ending inventory. Budgeted product sales in units plus the desired product units in ending inventory equals the total products needed. Total products needed minus the product units in beginning inventory equals the number of product units that need to be produced in that period. The production budget requires finished goods inventory to be 1.4 times the next month's budgeted sales in units. Now remember, we're just dealing with Jones. This is an arbitrary number for Jones only. Each organization is going to have a different metric here. There are 14,000 units on hand December 31st, and the sales forecast for January is 10,000 units. So let's look at how we would determine those numbers in kind of a spreadsheet form. We start with the sales budget, and then we add the desired ending inventory. Budgeted unit sales for January were 10,000, for February 12,000, March 15, and April 11,000. Desired ending inventory is 1.4 times the next month's budgeted sales. So that's how we came up with what we want the ending inventory here to be. Next, that's going to tell us how many units are needed to satisfy this threshold at this number of sales. The total units needed less the beginning inventory is going to equal the amount of units that need to be produced in that period. So for example, January budget sales are 10,000 plus calculated desired ending inventory of 16,800 gives us total units needed of 26,800. They had beginning inventory, or December's ending inventory, of 14,000 units. This equals 12,800 units that need to be produced in the month of January to fulfill our budgeted unit sales and provide us with the necessary desired ending inventory to begin our month of February. Note that the beginning inventory each month is the previous month's ending inventory. Once we know how much we need to produce in a given period, then we can move into the product cost budgets. First, there's the raw material purchases budget. The materials purchase budget is based on the production quantity and the desired materials inventory levels. The specific calculations are shown here on the slide. We know how many units to produce. We need to multiply that by the materials needed per unit, and that's going to tell us the materials that are needed for the units to produce. We need to add what our desired units of material and ending inventory is. That's going to tell us the total amounts of material that will be needed in this period. We reduce from that the unit of materials in beginning inventory to tell us how much in materials we need to purchase. Let's look at this from Jones's perspective. There are 3 pounds of material that are needed for each unit produced. Each pound of material costs 90 cents. Jones wants to have materials on hand at the end of each month equal to 50% of the following month's production needs. The materials inventory on December 31st is 19,200 pounds. So as you can see, how we look at this is we're looking at it from quantity of materials, not necessarily dollar value of materials. The number of units to produce in January, taken from that production budget, is 12,800. February is 16,200. March is 9,400. We multiply this by the pounds per unit to determine the material needed in pounds. We then calculate what we need in our ending inventory. And remember, that's half of the materials needed in the next period. This is going to tell us how many total material needs there are in pounds. We reduce from that the amount of the beginning inventory. So on December 31st, there was 19,200. Our ending inventory in January is 24,300. That's the beginning for February. And then that tells us what materials purchases are going to be required. We have 43,500 pounds of materials purchases that will need to be incurred in the month of January. With the materials purchases budget complete, we then move on to the next factor in product cost, and that's direct labor. Each unit produced requires 6 minutes, or 0.10 hours of direct labor. Jones employs 23 persons for 40 hours each week at a rate of $10 per hour. Any extra hours needed are obtained by hiring temporary workers who are also at a $10 per hour. So for the direct labor budget, the number of units to produce is multiplied by 0.10. If we need to create 12,800 units and it takes 6 minutes to create them, then that is 1,280 hours of labor that is required. The total hours required is then multiplied by the $10 direct labor rate per hour to calculate the budgeted direct labor costs for each month. These calculations are shown right here. With the direct labor budget now complete, let's move forward to the manufacturing overhead budget. Variable manufacturing overhead is $1 per unit produced, and fixed manufacturing overhead is $50,000 per month. So to calculate the variable overhead costs, the variable overhead rate of $1 is multiplied by the number of units to be produced. Because remember, variable will change based on that production and based on sales. Fixed overhead is not going to change. It is the amount it is in total, regardless of what the production level is. Fixed overhead is then added to the variable overhead costs to determine total manufacturing overhead costs of $62,800 for the month of January, $66,200 for February, and $59,400 for March. Now, with the manufacturing overhead budget complete, let's prepare the selling and administrative budgets. Some of our selling and administrative expenses are going to be variable, where some of them are going to be fixed. Variable selling and administrative expenses are 50 cents per unit sold, and fixed selling and administrative expenses are $30,000 per month. So we can populate our fixed across the board. We have to take the amount of budgeted units to be sold and multiply that by the 50 cents per unit to determine what our variable selling and administrative expenses are going to be in each of these given months. We add that to our fixed selling and administrative expenses. We come up with a total of $35,000 selling administrative expenses in January, $36,000 in February, and $37,500 in March. We take this just a slight step further because remember, we want to look at not only an accrual basis, but we're going to be doing a cash budget. So we need to deduct depreciation from these. And that gives us what our selling and administrative expenses are in actual cash. With the selling and administrative budget complete now, we can actually begin creating the budgeted income statement. All of these other budgets feed into the budgeted income statement. So we created a lot of numbers, but all of those numbers and all of those little different budgets from the sales forecast all the way to the manufacturing overhead budget, all are factors that feed into our budgeted income statement. We start with our budgeted sales. The budgeted sales, we're doing these on a quarterly basis, remember, for the 3 months is $925,000. That is the 37,000 units multiplied by $25 per unit. This is, of course, the first element of any income statement is sales or revenues, and is the first line of the budgeted income statement. We then take the cost of goods sold, which is $318,570. That is 37,000 units multiplied by $8.61. That is when we break down the three elements, direct materials, direct labor, and manufacturing overhead, for those 3 months on a per unit basis, we come to $8.61. The manufacturing overhead is taken from the predetermined manufacturing overhead rate of estimated manufacturing overhead costs divided by the direct labor hours required. This then tells us that we will have a gross margin of $606,430. We determine the manufacturing overhead from both the production and the overhead budgets. So how many hours from those production, from that direct labor budget, and then what is the costs we expect to incur from the manufacturing overhead budget. You cannot skip any one of these elements, or else you will not have inaccurate budgeted income statements. We then populate our selling and administrative expenses that we determined in the selling and administrative expenses budget. So from the selling and administrative expenses budget, we had $35,000, $36,000, $37,500 for a total of $108,500. This gives us operating income of $497,930. We would then populate any of the non-operating expenses. In this case, there's an interest expense of $50, giving us net income of $497,880. We have now completed the budgeted income statements. From this, we can then move to the cash budget. The cash budget is really important because it allows us to participate in cash management, to recognize periods in which we might need to take out financing in order to cover our cash needs for a particular point in time. All sales for Jones are on account, and their collection pattern is 70% is collected in the month of sale, 29% in the month after, and then 1% will be uncollectible. Accounts receivable on December 31st is $30,000, all of which is deemed to be collectible. So we populate the sales, the price per unit, and this gives us what our budgeted sales revenue is. We have additional $30,000 in receipts that we expect to collect from December's. We multiply the $250,000 times the 70%. We have the other 29% from January here. And we do this for each of the months. We calculate down, and this says that we should have $205,000 that we'll collect in the month of January, $282,000 we should collect in the month of February. That is the 29% from January, and then the 70% from February, and $349,500 that we expect to collect in March. Next, we look at what cash payments for materials will be. Remember, materials used in production cost 90 cents per pound. 1/2 of a month's purchases is paid for in the month of purchase. The remaining is paid for in the following month. There are no discount terms that are available, and the accounts payable balance on December 31st is $18,000. The cash payments budget for materials is shown on this slide. January cash payments include the $18,000 from the December purchases, and then 1/2 of the January purchases. That is $19,575. That is 43,500 pounds of materials at 90 cents per pound. And then 1/2 of that in January, 1/2 of that in February. January purchases of $19,575 are added to the $18,000 for the December purchases, for a total of $37,575 in cash payments for materials to be budgeted for the month of January. 1/2 of the February purchases is $17,280. That is the $34,560 of total costs multiplied by 0.50, and will be paid in February. The remaining 1/2 will be paid in March. February purchases are added to the $19,575 of residual January purchases to be paid, for a total of $36,855 of cash payments for materials to be budgeted for the month of February. 1/2 of March purchases of $13,995, which is the $27,900 multiplied by 0.50, is paid in March. The remaining 1/2 is paid in April. March purchases of $17,280 are added to the residual February purchases of $17,280 are added to the March purchases of $13,995 to come up with a total of $31,275. Now, with just a slight bit more information, we can actually prepare the entire comprehensive cash budget. Some of the additional information that we might need to complete the cash budget is what is the line of credits that is available, and what is the interest related to it, what type of minimum cash balance are we requiring, how is the repayment schedules for monies that are borrowed, what are the interest rates on any principal loan and any principal payments that are made on loans, are there any cash dividends expected, are there any purchases for things such as equipment, plants, property in those coming months, and what type of cash balance do we have to start with. Now, this is just an illustration for Jones, but as you can see, it's anything that's going to impact cash that we need to know about in order to create the comprehensive cash budget. So let's look at how that would populate for Jones. Jones had a beginning cash balance of $25,175. They expect to have cash receipts from the cash receipts budget of $205,000 in January. So this would equal an amount of cash available in that month of $230,175. Cash payments for items from the other budgets are then detailed and deducted from the available cash to arrive at the balance before financing. So you see here, what was the materials budget? What is the labor? What is the manufacturing overhead? What are the selling and administrative expenses? Any equipment purchases, dividends. And this says how much cash payments or cash outlay we expect. This would give us $15,000 in cash available. We require a minimum balance of $20,000. So therefore, we would be required to borrow $5,000 to come up with $20,000. This gives us our new beginning balance, and we follow that exact same process for the next month. Now we have cash before financing of $39,000. We have a repayment frequency of repaying the next month. So the $5,000 loan would be repaid, and there would be $50. That's $5,000 times 12% interest times 1 out of 12 months in interest in order to come to an ending cash balance of $33,950. We're above the $20,000 threshold, so there's no borrowing required. We carry that over to start our month of March and continue the process. Now, at the end of the quarter, we should have an ending cash balance of $59,335. Now that we have completed the cash budget, we can move forward and prepare the budgeted balance sheet. Jones has the following account balances as of March 31st, prior to preparing its budgeted financial statements. We have our land, we have our net buildings, we have our net equipment. Now remember, that is cost less accumulated depreciation gives us a net amount. We have common stock and our retained earnings. We should have $59,335 of cash. This is transferred from the cash budget that we just completed. The accounts receivable balance is then based on the 29% of March sales that will be collected in April. There are March sales of $375,000. 29% of that is going to be $108,750. The raw materials balance is based on 17,000 pounds, which is what we would require going into the month of April, and 90 cents per pound. The finished goods inventory balance is based off the required 15,400 units from the production budget at the amount determined from the 3 product cost budgets of $861 per unit. The March 31st balances for land, building, and equipment accounts are then given. The accounts payable balance is based on the 50% of June purchases that will be paid of March purchases that will be paid in April. The March 31st balances for common stock and retained earnings accounts are given. The balance in the accounts receivable is 29% of the budgeted March sales to be collected in April. The balance in raw materials of 15,300 is the 17,000 pounds of raw material at 90 cents per pound. The finished goods inventory of 132,594 is 15,400 units at $8.61 each. Accounts payable is 13,995. That is 50% of the March orders. The ending balance for retained earnings is determined by adding the beginning balance of 205,604 plus the budgeted net income of 497,880 less 77,000 of dividends to be paid to arrive at $626,484. Managers are an integral part of the budgeting process, so it is important that they understand how all of these various components roll over and what those relationships are, such as what is retained earnings. Retained earnings is beginning retained earnings plus net income less any dividends. Now that we have completed the budgeted balance sheet, we're going to talk a little bit about things like standard costs. Standard costs are based on some carefully predetermined amounts. They're used for planning purposes, such as planning materials, labor, and overhead requirements. Standard costs are set at an expected level of performance and are basically used as benchmarks for measuring performance through time. Standards are not the same as budgets. A standard is an expected cost for a single unit, where a budget is the expected cost for all units. Accountants, engineers, personnel administrators, production managers, a variety of people are used and combine their efforts to set standards that are based off experience and expectations. Attainable standards should be set at levels that are currently achievable with reasonable and efficient effort. Managers agree that ideal standards based on perfection are not attainable, and they discourage most employees. Standards should not be based on past experience, because past experience contains inefficiencies and provides little incentive for improvement. However, that experience allows you to determine what your new standard might be if you were to insert certain levels of efficiencies and create a new expectation. So while it's not based on past experience is a part of looking at what a new standard might be. Price standards should be based on the final delivered cost of materials net of discounts, where your quantity standards use product design specifications. Rate standards should use wage surveys and labor contracts. And your time standards should use time and motion studies for each labor operation. The standard rate is the variable portion of the predetermined overhead rate. The activity standard is the base used to calculate the predetermined overhead rate. Typically, when you're calculating for standards, this might be the type of spreadsheet you would create. Standard costs for a product include a standard quantity of hours, the standard price or rate to determine the standard cost per unit. So for example, raw materials has a standard 3-pound quantity at $4 per pound for a standard cost of $12. The direct labor standards are 2.5 hours at $14 per hour for a standard cost of $35. Variable overhead standards are 2.5, which is applied at a rate of $3 for a standard cost of $7.50. And then the fixed overhead standard is 2.5, which is applied at $4.50 for a standard cost of $11.25. The costs are then summed to arrive at a total standard unit cost. Other uses of standards could be things such as machine usage. They can be used for inventory control. They can be used for quality control, training levels, sales levels, safety goals, service levels. They're one of the planning, monitoring, and control procedures that we use in order to arrive at as efficient and effective an organization as possible. You have to be able to compare operations to something. We start with the compare to the standards. What is the expectation? Are we meeting that expectation? If we are not meeting that expectation, why?